Welcome to this special presentation, Climbing the Wall of Worry. My name is Steve Chappell, the Director of Trading Systems Development here at VectorVest, and I'm delighted to bring you this timely presentation. Let's jump right into it and take a look. So the markets have come a long way. I mean, this is just a depiction of the markets from the November low just prior to the election, and boy, what a good market we've had. This year has been a tremendous year for the stock market. And if we think in terms of when the bull market began, boy, we have to kind of think way back, don't we? We have to go back to March of 2009 when Citigroup announced that they turned a profit in the first quarter of the year. And when blood was in the streets, that's all the markets needed to know to figure that earnings were starting to come back together, and the markets took off and really have been performing well overall ever since. And so the higher the markets go, the more resounding the questions, right? How much higher can the market go? And you have all these prognosticators and predictors out there, some of which saying Dow 50,000, and you've got all kinds of doomsayers and so forth and so on. And so it leaves investors in a pickle in terms of the investment psychology and realizing that markets are high and how much higher can they go. The fortunate thing for you folks is that you have the answers right within VectorVest, and we don't deal with prediction. What we do is we look at the facts and we use our data that we have in the system to really give you guidance that you deserve and that you need. And so I just wanted to set the stage by pointing out that it's been a long, really long, good bull market, and there's some interesting things beginning to happen as we go higher and higher here in the markets. Investors are really beginning to struggle with this, and really they're starting to, well, you see situations like this with Ultra Clean Holdings. Here's a situation where the company came in on the low side of what they gave as far as their guidance, and it was under the street estimate, of course, but beat on sales, even on the street numbers, had a really decent report that you'll see later. We're going to dig into some of the better data here in a bit, but really had a pretty good report. Here's a company that does nothing but make more money quarter after quarter, year after year, and they just come up on the low side of things with their EPS, and boom, it gets hit, and in a big way. Certainly maybe a little bit of capitulation here might have been normal given the current circumstance, but it just seems like investors are panicking and they're really bailing out on just the slightest inkling, the slightest little bit of inkling of weakness in the stocks that they've been holding for a while and have huge profits in. And so it leaves a lot of us, though, scratching our heads and saying, what's going on here? It certainly didn't warrant this kind of dip in the share price. Well, what we need to do is we need to step back and remember how markets work, where we are in the current state of affairs, and what that means and what we can do to track things moving forward to give us the peace of mind that, the end is not near and the bull market is in fact likely to continue. So let's talk about things. So bull markets are born when the economy is weak, inflation and interest rates are low, and earnings therefore are expected to rise. And just as in the indication I gave earlier with Citigroup, that was the culprit, the instigator behind the most recent beautiful bull market that we've been in. And that was a situation where the economy was weak. We're fresh off of the financial crisis and the housing bubble and all this. And, Citigroup comes out, they say, what? Looks like we turned a profit first quarter of the year. That's all the markets needed. There was blood in the streets. And that's the piece of news that really sent things skyrocketing. And so the opposite end of the spectrum, I think what's paramount in everybody's mind now is, when's the next bear market begin, right? Because we're long in the tooth and this and that on the current bull market situation. Well, the economy, bear markets are born when the economy is strong, inflation and interest rates are high, and earnings are expected to fall. And so we are in a situation where the economy is clicking along. Strong might be a strong word, but clicking along. Inflation and interest rates are on the rise, but certainly fairly low in the spectrum of things considering where they've been in the past and so on, etc. But the real enemy of earnings here is inflation, and inflation has been on the rise. And higher interest rates, they can be indicative of a strengthening economy, actually, right? But at some point, they're both sort of the enemies of corporate earnings. And so to get a better understanding of all this, the one thing I want you to know now is earnings is the key. Earnings is the key. We want to track earnings. We don't want to just track today's earnings. We want to have a feel for where earnings will be a year from now. And that's exactly what VectorVest provides. We provide a great earnings number, a better earnings number than anyone out there, and you're going to get a peek at that here as a good reminder. Okay? So we monitor earnings, and we monitor our 12-month leading forecasted earnings per share, along with inflation and interest rates, market direction, and investor sentiment, in a place in the platform in the VectorVest views called the investment climate. And there's a wealth of information in there. We'll take a peek at it here in a second. But one of the things that I want to draw to your attention, there was a couple of great essays written back in March of 2003, on March the 21st and March the 28th. And that's when Dr. DeLito did a lot of good writing around the truth chart. And so what he presents here is that we boil things down into analyzing earnings, inflation, and interest, E for earnings, F for inflation, I for interest, and then the resulting price action. And so what it amounts to is, when factoring those three key elements, earnings, inflation, and interest, you can really bake things down into 8 scenarios. 4 bull market scenarios and 4 bear market scenarios. And the one thing, I could put a lot of commentary around this table, okay? But the one thing that I want to drive home the most is that in each of the 4 bull market scenarios, the one common denominator is that earnings are up. Earnings are up and rising. The one common denominator for all the bear market scenarios is that earnings are down, and that means falling. And so earnings is the key. Inflation and interest can become a problem, right? They can also become a catapult, but earnings is the key, and earnings is the focal point. And I'm just going to leave it at that for this presentation, okay? But here's the current situation that we find ourselves in. We find ourselves in the case 4 bull market scenario, and that's where earnings, inflation, and interest rates are all on the rise. They're all rising. And so, as mentioned earlier, earnings has a couple of enemies, being inflation and inevitably at some point interest. So what we need to do is focus on earnings, look at how it's performing, look at where our earnings per share in VectorVest is headed, because we provide a nice 12-month leading forecasted earnings per share, as I mentioned. And that gives us a window into the future. So as long as our earnings number in VectorVest is rising, that means corporate earnings should rise over the coming year, and that bodes well for the stock market, as you saw from the prior tables. So again, we're currently in a case 4. No need to panic just yet, because I've got some good news for you in this regard, in terms of the key thing to watch is earnings. So our outlook, the bull market will continue as long as it's perceived that earnings are rising. And as as you'll see in the views, we're monitoring earnings very closely. So you want to keep abreast of the views, read that little ETI summary section, and you'll note that so far through FactSet, I can't see today's numbers yet, but so far through FactSet, all things have been looking really well, not only on EPS across the S&P, but also on sales numbers to boot, which is like icing on the cake. So everything seems to be holding together pretty well on a current basis. However, because the bull market has been going on for so long, and because the markets are perceived, at least from the pricing of the markets standpoint, to be high, right? Of course, you could have had the same perception 2 years ago. But investors are at this point, it's really becoming evident, like with the case of UCTT and some other stocks that I'll go through, it's becoming evident that investors are really starting to get nervous, right? And they're looking for all kinds of any inkling of a reason to sell their stock and lock in those profits. And so now is the time to stay vigilant, stay alert, but let's follow earnings. We'll see how earnings is performing and see where stock prices are likely to continue to head. But another key thing to learn from what we've covered so far, guys, if you don't know how to do put insurance against your stocks, you need to take our options course. There's just no way around it. You can't afford not to know it, because in the case of owning a UCTT or a Biogen or some of these other stocks that have taken some hits here recently, a put option could have mitigated most of that. And it's just worth the peace of mind. And it's really, as Jim would tell you in worry-free investing, what really helps make worry-free is being able to own that put contract and offset a bunch of loss should it happen. And if it doesn't happen, you just sell your insurance and you get most of the premium back. So that's something to consider here as well. But particularly in times like this, where it just seems like investors are looking for the reason to sell stocks, right? So here's some other quick examples. We looked at UCTT. When you really dig into the articles, most of these are taken right off the Yahoo news feed. So just as a real quick aside, in VectorVest, you can right-click a stock and go to View Stock News. It'll take you right out to Yahoo, and you could pick these same articles out, okay? But we'll look at Ultra Clean Holdings here first. So this is just one of the articles in the feed, and I love sort of the headlines here. It says, how Ultra Clean Holdings shares fell 24% today. What happened, right? What happened? Shares of Ultra Clean Holdings fell as much as almost 24% on Thursday morning session. The maker of the manufacturing equipment for the semiconductor industry reported mixed earnings. Like I told you, I kind of already went through some of the numbers here, but investors were quick to fixate on Ultra Clean's earnings miss. So when you dig into the numbers a little bit deeper, it's fascinating, because here's a company whose third quarter sales jumped 66% compared to a year ago, and landed at $243 million. And on the bottom line, adjusted earnings more than tripled to 62 cents a share, right? More than tripled. And you have this big hit on stock price. So it's just fascinating to look at this, and you realize, what? Markets have soared so high and come so far that people are just getting fearful, and that's the bottom line. So you can dig into the articles a little bit more, but I just wanted to at least give you some documentation and some evidence. Here's Biogen. Biogen's taken such a hit now, people got a little nervous about their pipeline of drugs and that there might be losing some market share to other drugs that are out there and things like that. But you've got analysts now, after this correction, coming on board in publications like Barron's saying, let's start all over again. Okay, here's an analyst who's upgraded after the recent slide and says, what a great buying opportunity, right? Because people are really worried about what might, coulda, woulda, maybe happen in the future, instead of focusing on brass tacks, which is, here's a company in Biogen that makes more money quarter after quarter, year after year, than a lot of other companies that are out there, And so it's just an interesting psychological mindset that happens here to investors, and they just get nervous. iRobot was another example. iRobot, they beat both earnings, knocked it out of the park actually, earnings and sales. And there's some litigation and patent infringement, litigation that they may have to go through to try to fight off some competitors and things like that. But by and large, you've got people now coming out. There was an analyst downgrade, and that's really what sent the stock plummeting. Was just a heavyweight analyst saying, it's really only worth about $65 a share, currently trading, well above that, and boom, down she went. So fortunately for you, we deal in facts, and we teach things like being able to buy insurance in case one of these things were to, unforeseen happen to a stock that you might own. But the better news is, what a great buying opportunity potentially on some of these stocks, right? So what we need to learn to do as investors is look for opportunity like this. And one of the ways that you want to stay focused in on the markets and realize that things probably aren't as bad as anybody thinks right now is to study the market climate graph. And it's a wonderful little graph. We don't give it enough airtime in VectorVest, I don't think. And so what I'm going to do is show you a little bit around that graph right now. I'm going to move over back into VectorVest. I'm going to come right up to the top, go to the Graphs tab. Over on the left, I'm going to pass over the market timing graph for the moment, although we're going to come back to that. Let's continue to talk about the 30,000 foot view. Then we can dial into dealing with consolidations and things in a moment. So I'm going to go to market climate here. And on the market climate graph, out on the right, there's a control panel. And so in the control panel, I've got clicked on the S&P 500 earnings and the S&P earnings VV. And so another thing that I like to put on here, and I've seen Dr. DeLito pass this along in the views and at a lot of trade shows that I've worked with him, is to actually right-click on S&P 500 earnings, add a moving average, simple, and then a 50, because that'll give you a pretty good feel of things as well. So I'm just going to dial that up to 50. As long as earnings are tracking above and hopefully rising above the 50, as you can see on the top chart, things are going along pretty well. Okay. You certainly don't like to see situations where earnings begins to dip and head towards the 50, but this will give you a good baseline to work from to realize that things are still pretty well okay. All right. If we go back to a 10-year, the reason I point this out, on the bottom we also have the S&P 500 earnings VV, and you'll notice that the two pretty well tie together in terms of the 50. There's a little bit extra math around it, of course, but both are valuable to look at. And one of the things that that gives us the ability to navigate bull and bear markets is to analyze these trends. And so that gives us the ability to write essays on like November the 2nd of 2000 and the ability to write essays on November the 2nd of 2007 that it looks like we're heading towards a long bear market. We're not there yet because according to our method of analysis, earnings are still rising. But you can see the rate of ascent had really begun to slow. We're almost reaching sort of a failure rate here where it looks like earnings are going to dip below the 50. The earnings trend indicator had really been flattening out. And of course, the move on the S&P earnings VV, which oscillates above and below 1, really crossed below 1 on February the 15th. And that was when in VectorVest we would have reassured you that you are now in fact in a bear market scenario. You can see that earnings hadn't quite crossed the 50 at that stage. But they're valuable to look at. They're valuable to look at in conjunction. You'll also notice that the catalyst for the current bull market came well before the whole earnings numbers began to turn around on the market. Citigroup announcing that they turned a profit in the first quarter, came at a time when blood was in the streets. Investors were grasping for any piece of good news that the markets were starting to turn around, and it came in the form of Citigroup. And eventually, all the stocks also began to increase their profits, and inevitably we entered into bull market scenarios when the ETI crossed above 1. And so it's incredibly great information, and I want you to know that we use this a lot and monitor the investment climate on a weekly situation in the VectorVest views for you. And so I definitely want to show you that here in a sec, but just note that look how earnings has performed ever since the bull market began, and earnings of course are still continuing to rise. We did have this interesting situation occur back here in 15-16, and since we took the time to show you the chart and took the time to put the 50 MA on there and talk about the earnings trend indicator at the bottom, I felt it appropriate once again just to remind some folks, or for people that are brand new, indicate what was happening here was a bit of unusual circumstance in that the petroleum stocks were really weighing down on the earnings numbers of the S&P. And so if I go to viewers here real quick, come over to the left and go to our watch list section. Go to the S&P watch list. You'll notice a variety of watch lists in here. They were put in there as a result of that. When you take petroleum out of the S&P, there's a good number of petroleum stocks in there, by the way. When you take the petroleum out, I can then come to the bottom here, right click on the watch list average graph and view it. You'll see a little different picture, right? Let me go to the same last 5 years here. And what I'm going to do is take all these moving averages off and plot EPS, because that's the engine that drives stock prices, right? Rising earnings leads to rising stock price. It's bull market scenarios, right? And what you see is earnings has really been moving nicely here for the last 5 years. And so when you look at the petroleum, it's a different picture. It makes that number sag quite a bit. And if you look at them exclusively, you can really see the sag. So feel free to investigate that. But that's what you saw there, and we were able to coach our subscribers through that. The focal point that you want to focus on now is earnings are really clicking along pretty well. If you look at earnings in isolation of just this year, look at that in terms of where we've been over the past several years. It just, earnings are just, they're not missing a beat right now. And so we'll see how the remainder of this earnings season goes. But by all accounts and what we've seen so far, I mean, Amazon and Google knocked the ball out of the park this morning, and the NASDAQ has been performing extremely well throughout most of the trading session today. So companies continue to meet, beat, and exceed, and it just, this is very, very useful information, because you don't have to worry about your investments, I don't think, as much as other folks that are out there that don't have this kind of insight. And you know that you might get some great buying opportunities on people that panic and get out of some rather great stocks. So it's just a tremendous tool, right? I'm going to go ahead and close this up. And the thing I also wanted to point out is in the VectorVest views on a Friday, so I'll have to go back to our prior Friday, we have a climate section. So right up by the calendar at the top, you can just skip to it by clicking on all, going to the climate section. And in here, you'll clearly see in the top, there's some great data up there, of course. But as you get to the second paragraph, it says we currently have a case for a bull market scenario in which earnings, inflation, and interest are rising. And so, the case for is when the bull market ends. But here's the rub. They can go on for a long, long time, and this one certainly has. And so, as long as earnings are continuing to rise, guys, things are going along rather well. And so that's where we find ourselves, and we could still be in this thing for years to come. We'll see. But the key is follow earnings, right? And our earnings in VectorVest more specifically, because we do a nice forecasted 12-month leading earnings per share. Okay. And on the table below, very quickly, you can monitor the EPS number here on the S&P 500, and you'll notice that on the 0 to 2 scale right now, as we discussed in the graph, we're well above 1 on a current basis. We're kind of paring back a little bit, dissipating a little bit on the scale, but still holding together very, very well. And so this is a great little table. Just real quick, not everyone understands what all these current levels mean. We have a couple of measures of inflation, a few measures of interest. What we do is we put these numbers on a VectorVest scale of 0 to 2. So above 1 is favorable for buying stocks, below 1 is unfavorable. Okay, and then you have a composite number there at the bottom. But the real key, the key to watch is this one right here. That is the EPS. It's not until it falls back below 1 that you enter into a bear market scenario of some sort. Remember, there's 4 cases. Okay. All right. So enough about that. Keep your eye on the ETI. All right. And I know Dr. Delito, I'm sure he'll be including a new ETI fact set information blurb tonight. All right. So what I'm going to do from here, guys, is simply say this. So now that we know that earnings are what really drives stock prices and what determine bull and bear markets and how they relate to earnings and inflation, interest and inflation, earnings being the key to keep your eye on, right? Earnings are rising. Things look pretty good. How can I navigate some of the turbulence that we're seeing here? You know, we talked about the idea of buying insurance on stocks that you own through earnings. That's a great policy, right? That's going to help you navigate turbulent times and not panic and be reactive. Be proactive, right? The other thing that you can do, of course, is realize the kind of market situation that you're in. And so what I'm going to do, I'm going to go to the market timing graph this time. So I'm going to go to graphs at the top, switch over to the market timing graph, and we'll note this, that while the market has, oh, this is end of week. Let me just switch this up here really quick. And we'll drag her back a little bit so that we can make some points here. One of the things that a lot of our astute investors that have been around VectorVest a long time know is that markets move in cycles, right? You're going to have great buying opportunities when markets are low, and then you're going to have opportunities where markets are high and they might consolidate to dip, to pull back, right? At some stage down the line, maybe even correction enters into the equation. But so there's buying opportunities, and then there's times where you want to be more defensive in nature. And so where we find ourselves now, the market's had a great run, right? You can see that depicted on this chart. And if we went all the way back to 2009, of course, it'd look even stronger, right? But the market has really begun to head sideways here a bit. And we've seen that before this year, right? We saw it back here in late July into mid-August or so. We saw it in late April on into about the middle of May, and so on, etc. So how can I know that a little pullback or a dip or a consolidation is on the way? Well, we have some proprietary market analysis indicators down here at the bottom. And in particular, I'm going to have you key in on the MTI and the buy to sell ratio. For every market day, we list where those indicators are on the scale. So the MTI is on a 0 to 2 scale. As it approaches 1.5 or higher, you're entering into what we've observed over the history of our database as a situation where the markets are toppy, and there might be some consolidation, some pullback, some dip, and from time to time when markets are more unhealthy, maybe even some correction. And so, you know, now's not the time to go for the gusto because when you look at where the markets are right now and where the MTI is, the MTI got very close. It got up to 1.49, and that's where the market has really slowed down. It got to 1.49 on October the 13th. And the markets have really just kind of moved down to sideways from there. Good resumption over the last couple of days. And so it's not to say that you can't buy stocks here. You just have to realize that, you know, your better buying opportunities were back when the MTI started to cross above 1, or maybe even coming up off a bottom like November of 2016. So that's, you know, but in terms of navigating the current market, just realize we're entering into a phase right now where it's just normal market sort of consolidation, and really doesn't seem to be amounting to anything more than that to us based upon earnings and how they're performing. Okay. If we look at where we are now and look at prior times that the market took a dip, we talked about the July into August, you know, the MTI got up into the high 1.4s there, or at least 1.44 right there, and at the peak. If we go back here a little bit further, we'll notice that pretty quickly here after the election, the number got quite high, and it doesn't mean sell everything because you know the market kept rolling. Did it move as fast and as far in such little time as it did coming into an MTI level of 1.5? No, you know, that's where it started to slow down, consolidate, you know, that kind of behavior, and it's clearly identifiable here on the graph. You know, so as long as the MTI is rising above 1 and rising, and you're getting green lights in the color guard, it's okay to be buying stocks. Even when you get up into these levels, you just got to realize that you're getting, you're off the bottom a considerable ways, and so you may not want to invest as much capital, or just play things a little bit more cautiously. And you're going to have these. This is a repetitive cycle. If you go back and you look at, there's probably 30 or 40 instances. I've never counted them, but if you go back and just look at what happens to the stock market when the MTI gets up into the 1.4s, 1.5s, you'll see that at the very least the rate of ascent slows down and it starts to consolidate. Sometimes it dips, sometimes it corrects, and it really depends on the kind of market environment you're in. With rising earnings right now, all this really appears to be just simple consolidation on a current basis. All right, and so there's a ton of data here. You can slide back, and anytime that it gets up high on that scale, let's go back to some of these that were a little higher on the scale for sure, and just dial into them. So market went sideways to down for a while, right, before it regrouped itself. Same thing back here, and as you keep scrolling back, it's going to keep being the same thing. MTI got up to 1.5s in July of 2013, and the market really just consolidated, slightly dipped here, and then regrouped itself and went on. So that's where we are right now, guys, and that's all I want to pass along. All we are is we're simply climbing the wall of worry, but worry no more, because as long as earnings are rising according to our method of analysis, that has been the key ingredient to help us guide and navigate turbulent waters for years. Earnings provides incredible insight. Just wanted to pass along some of this information. I think it's timely, and I think it'll really help you out, and hopefully you won't be as worried, you won't be as frantic, you won't be as panicked as a lot of other investors that are out there, and realize that, hey, maybe you can take advantage of some of that weakness from some of those other investors, and realize you're getting some terrific buying opportunities on some irrational price behavior on some stocks. So with all of that, I know this is probably already a pretty long presentation. I just want to say this: heed the color guard. If you see green in the color guard, particularly the price column, it's okay to buy stocks, plain and simple. The first green light off a bottom, that presents the best potential trading opportunity. But as long as you got a green light, it's okay to buy. Yellow, that's neutral. Caution is advised at those times. Red is bearish. Don't buy any stocks. And the color guard doesn't tell you when to sell. It just tells you if it's okay to buy or not, and it does a great job. Right now, if we look at the color guard, we're seeing a lot of yellow. On Monday, price, let's see, Monday, it'll be working off 1, 2, 3, 4, 5. It'll be working off a red. So can't go to a green on Monday. Could remain a yellow on higher stock price activity. But on Tuesday, could see some green lights again, as we'll be working off of a green at 45.17. We're already above that current price on a current basis. So with a rising market on Tuesday and things hold their own on Monday, could be seeing some green lights early on next week. Okay. So thanks for tuning in this week, guys. I wanted to give you that information because I don't want you to miss the next great opportunity. And all you got to do is get in there. And if you have any trouble at all, remember, just watch the daily color guard report in the evening. We're going to help you navigate through this. And it's worth your while to spend the 10 minutes or so just to get that information. Make sure you're seeing the right thing, right? So thanks again for tuning in this week. Hopefully we see you right back here next week for the next special presentation. Have a great weekend, guys.